In this video, we're going to be performing a deep dive on Franklin Resources dividend safety. To begin, let's talk about Franklin Resources' business model. Franklin Resources is an investment management firm that's involved in asset management, stock transfer services, and mutual fund distribution. The company is most well known for its Franklin Templeton brand of funds. Franklin Resources is headquartered in Mateo, California, was founded in 1947, and currently trades with a market capitalization of $16.3 billion. Franklin Resources is a well-known dividend stock because of its compelling track record of dividend growth. With 36 years of consecutive dividend increases, Franklin Resources is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, Franklin Resources' high dividend yield combined with volatility in the price of public securities, which impacts the company's fee revenues, has led some investors to question the safety of its current dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Franklin Resources' dividend safety in the context of the company's current earnings. On October 25th, Franklin Resources reported its fiscal 2018 fourth quarter financial results. The company generated adjusted earnings per share of $3.37 in the 12-month reporting period. For context, Franklin Resources currently pays a quarterly dividend of 23 cents per share, which implies a payout ratio of just 27%. Using earnings, Franklin Resources' dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Franklin Resources' current dividend payment to its free cash flow. In Franklin Resources' recently completed fiscal 2018, the company generated $2.23 billion in cash from operating activities and spent just $106.5 million on capital expenditures for free cash flow of $2.12 billion. Franklin Resources spent $2.11 billion on common share dividends during the same time period, for a free cash flow payout ratio of essentially 100%. While this might be alarming on the surface, it's important to keep in mind that Franklin Resources paid a sizable special dividend during fiscal 2018. This special dividend amounted to $3 per share, or $1.61 billion when multiplied across the company's weighted average shares outstanding. If we exclude the special dividend, Franklin Resources paid normal dividends of just $500 million in fiscal 2018, which is equivalent to a free cash flow dividend payout ratio of 24%. Using free cash flow, our conclusion is the same as when we used earnings per share to measure Franklin Resources' dividend safety. The company's dividend appears safe for the foreseeable future, and its payout ratio using free cash flow is actually lower than its earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Franklin Resources' current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Franklin Resources' performance during this time period is shown here. Franklin Resources' earnings per share were extremely volatile during the last recession. Indeed, the company's earnings per share declined by 45% during the worst of the financial crisis. With that said, Franklin Resources' dividend was covered each year of the last recession. Moreover, the company's dividend would be covered today if it experienced a similar 45% decline in earnings. Because of this, we feel confident that Franklin Resources' dividend will survive any short-term economic contractions. The last angle that we will use to assess Franklin Resources' current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. In Franklin Resources' most recent 10K, the company revealed that it had $300 million of 2.8% notes outstanding and $400 million of 2.85% notes outstanding, for a weighted average interest rate of 2.83%. The following image shows how changes to Franklin Resources' weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, the company's very low debt levels mean that there is no practical level of higher interest rate at which Franklin Resources' dividend payments would not be covered by its free cash flow. Accordingly, We do not believe that Franklin Resources' debt will prevent it from paying its dividend for the foreseeable future. Thank you for watching today's video, which performed a deep dive on Franklin Resources' current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.